All right, I need you to lock in right now. What I'm about to show you is not speculation. It's not doom-scrolling panic. It's a transmission mechanism, a direct mechanical, documented connection between missiles falling on Iran right now and dollars disappearing from your retirement account starting Monday morning. I've been pulling data all weekend. I've been tracking the timestamps, the oil futures, the FDIC filings, the market structure, and what I'm seeing is a convergence, a multi-front simultaneous crisis that the financial press is only partially reporting, and I need you to understand all of it, the full picture, before Asian markets open in less than 24 hours. Here's the thing. Sunday night, 6 p.m. Eastern, that's when it begins. That's when Asian markets open. That's when the first real price discovery happens after a weekend of combat operations that most Americans don't fully understand yet. And according to Jorge Leon at Rissad Energy, speaking to Yahoo Finance just this morning, oil prices could surge $10 to $20 per barrel when those markets open. $10 to $20 in a single session. We closed Friday at 72.80. We could be looking at 82.90, maybe higher by Sunday night. And that's just oil. That's just the first domino. What I'm going to walk you through in the next 40 minutes is the full cascade. Not just oil, not just stocks. I'm going to show you exactly how combat operations in Iran connect to your grocery bill, how missiles in the Strait connect to your retirement account balance, how decisions made in Washington and Tehran this weekend create specific, calculable, unavoidable costs that land in your household budget, starting Monday morning, continuing for weeks, possibly months. And I'm going to show you the historical template, because we've been here before, exactly here, and the pattern is not encouraging. But first, I need you to understand what the last 72 hours actually looked like in the data, because the numbers tell a story that the headlines are burying. Part 1. What the markets already know that you don't. Let me start with Friday's close, because Friday tells you everything. The Dow Jones Industrial Average closed down 1.3% on Friday. The S&P 500 down 0.4%. The Nasdaq down 1.0%. And here's what I need you to understand about those numbers. That was before major combat operations officially began, before Iran launched what they're calling the Iron Reply, 200 missiles targeting 5 countries. Before Jordan intercepted 49 incoming threats in their airspace, before the US Fifth Fleet headquarters in Bahrain was struck, before civilian casualties were reported in Abu Dhabi from falling missile debris, before any of that. Friday's decline was priced on anticipation. Monday's open will be priced on reality, and reality is always worse than anticipation. Always. That's not pessimism. That's market structure. Markets price expected outcomes, not full outcomes. The expected outcome was a limited strike. The reality is sustained combat operations with Iran promising, their word, relentless attacks. The delta between expected and actual is where your Monday morning losses live. Now, here's the mechanism I'm tracking that most people aren't focused on. Gulf equity markets, Saudi Arabia, Qatar, Dubai. They open Sunday. That's 18 hours before US markets. They are the preview. They are the forward signal. And according to Ryan Leand, CEO of Neo Vision Wealth Management, speaking to Reuters this morning, Gulf equity markets could drop 3 to 5% depending on conflict scale. 3 to 5%. Let me show you why that number matters directly for your account. When Gulf markets drop 3 to 5% on Sunday, US futures gap down accordingly. Now, I want to make sure you understand what a gap down means, because this is where your structural disadvantage lives. A gap down means your retirement account opens Monday morning at a price significantly below Friday's close, without ever trading at the values in between. You cannot sell to prevent the loss. You cannot react. You cannot act. The price simply jumps from Friday's close to Monday's open while you were sleeping, while you were at church, while you were watching NFL recaps, while you were completely unaware that Asian and European institutional traders were repositioning. They trade while you sleep. That's not a conspiracy. That's market architecture. And here's what that gap down means in real dollars. According to Federal Reserve data, the median American retirement account balance is $130,000. A 3% Monday gap down is $3,900. Not $3,900 over a bad quarter. Not $3,900 at the end of a down year. $3,900 between Friday afternoon and Monday morning. A window during which you had zero ability to act. During which retail investors, you, were locked out while institutional players with access to overnight trading in overseas markets were actively repositioning. Let me be direct about what that means. By the time you check your account Monday morning, the people who needed to move have already moved. The information that's causing your loss? It was acted on hours ago by traders who weren't sleeping. You are always last to know, last to act, first to lose. And that's not an accident. That's the structural design of a market that advantages those with access to information and overnight trading over those without it. I'm telling you this not to demoralize you. I'm telling you this so you understand what you're actually dealing with going into this week. $3,900 is just Monday. That's just the first invoice. Let me show you the rest of the bill. Part 2. The oil transmission. How $20 oil becomes $1,800 in annual costs. Here's what I found when I pulled the transmission analysis on oil price shocks. And I want to walk you through this step by step because the speed of this matters as much as the magnitude. According to Energy Price Transmission Research, a $10 increase in crude oil prices raises gasoline prices approximately 25 cents per gallon. If Leon's projection is correct, if oil jumps $20, we're looking at gasoline moving from the current $3.50 to approximately $4, possibly $4.50, possibly $5. And here's the timeline I'm tracking. Oil price changes hit gasoline within days, not weeks, days. By next Friday, if combat operations continue and Iran makes any move toward the Strait of Hormuz, even a partial threat, not an actual closure, just a threat, we could be looking at $5 gasoline by the end of next week. Now let me quantify what that means for your budget specifically. The average American driver consumes approximately 500 gallons of fuel annually. At $3.50, that's $1,550 per year. At $5,000, that's $2,500. That's $750 in added annual fuel costs from a single geopolitical event you had no part in causing. Your weekly fuel budget goes from $70 to $100. That's $30 per week. And you can't reduce driving because your commute is fixed. Your job requires you to show up. Showing up requires fuel. Fuel costs whatever the market charges. There is no negotiation, no flexibility, no alternative. You absorb the cost or you don't work. But here's where the transmission gets more complex, and this is the part I really need you to track. Oil prices don't just affect gasoline, they affect diesel. Diesel affects trucking costs. Trucking costs affect retail prices. And here's what makes this timeline dangerous. Trucking cost increases transmit to retail prices within 2 weeks. That means by mid-March, you're starting to see grocery prices move. According to household spending data, the average American family spends approximately $7,000 annually on food at home. A 5% grocery price increase, conservative given diesel dynamics, is $350 per year. Add that to the $750 fuel increase. You're now at over $1,100 in annual cost increases, and we haven't touched natural gas, heating costs, or utilities, all of which correlate to oil price movements. Let me give you the April 1st projection. Project forward 1 month. It's April 1st. War continues. IRGC continues its relentless attacks. Oil has settled at $90 per barrel. Gasoline at $5. Here's what your monthly budget looks like. Monthly fuel cost moves from $280 to $360. That's $80 more per month. Monthly groceries from $600 to $660. $60 more. Monthly utility bill from $120 to $144. $24 more. Total monthly increase from the oil shock alone, $164. Multiply by 12 months, $1,968 in annual purchasing power destruction, nearly $2,000 per year, added on top of the $3,900 you already lost from Monday's market decline. And I need you to add one more number to that stack. If you're carrying any credit card balance at the current average APR, which according to Federal Reserve January data is 23.79%, and you're charging $2,000 in expenses that your income can no longer cover because costs rose faster than wages adjusted, that's $480 in annual interest that doesn't reduce your principal, minimum payments that barely move the balance, years of paying 24% on consumption that was necessary, not a vacation, not a new TV, necessary, groceries, gasoline, utilities. That's the debt trap I'm watching form in real time. Not a trap created by irresponsible spending. A trap created by the income-expense mismatch that oil shocks produce. A gap that closes with debt. Debt that compounds. That's the mechanism turning a temporary shock into a multi-year financial burden. Part 3. The banking system, the hidden stress that was already there. Now I need to add a layer that most of the weekend coverage isn't connecting, and this is the part that concerns me most. Because everything I've described so far, the market decline, the oil transmission, the inflation costs, that's the surface layer. Under that surface, there is a banking system that was already under stress before the first missile launched. According to FDIC data released 48 hours ago, and I mean literally 48 hours before combat operations began, 63 American banks are currently reporting $517 billion in unrealized losses. Let me say that again, $517 billion in unrealized losses. 63 problem banks collectively holding $82.1 billion in assets. And here's the timestamp that matters. This is the 9th consecutive quarter of elevated unrealized losses. Not one bad quarter. 9 consecutive quarters of a banking system slowly accumulating stress, like a fault line building pressure. That was before war, before the oil spike, before the market stress, before any of this weekend's events. The banking system walked into this weekend already fragile. Now let me show you the mechanical connection between oil prices and bank balance sheets, because this is the plumbing that almost nobody is explaining right now. Banks hold bonds. Bonds lose value when interest rates rise. Interest rates rise when inflation rises. Inflation rises when oil prices spike. Oil prices are spiking right now, tonight, as Asian markets prepare to open, which means right now, tonight, bond values are declining. Bank capital ratios are compressing, and compressed capital ratios trigger a sequence that lands directly in your life. Here's the cascade. Declining bank capital means reduced lending capacity. Reduced lending means credit tightens. Tight credit means businesses cannot borrow to expand, to hire, to invest. Slower business investment means slower economic growth. Slower growth means reduced corporate revenues. Reduced revenues mean lower earnings. Lower earnings mean lower stock prices. Lower stock prices mean your 401k declines further, beyond Monday's initial gap down. And credit tightening is already visible before this weekend's events. According to Federal Reserve data from January, average credit card APR is 23.79%. When Trump proposed capping rates at 10% in January, banks responded immediately by tightening standards, reducing limits, increasing denial rates. Banks cannot extend credit profitably at 10% for risky borrowers, so they stopped extending credit. And here's where oil shock plus credit tightening creates a convergence. War creates unexpected costs. Gasoline up 50 cents. Groceries up 5%. Utility bills rising. These are unexpected costs that families historically smooth by using credit. But credit is contracting exactly when unexpected costs are expanding. The buffer is disappearing precisely when the shocks are arriving. What happens when the buffer disappears and the shocks arrive simultaneously? Families miss mortgage payments, default on car loans, max out cards at 24% APR, and then can't cover minimums. Any of those breaks creates cascading problems. Missed mortgage payment damages credit scores. Damaged credit scores reduce access to future credit. Reduced access means the next emergency, and there's always a next emergency, has no buffer. Defaults accumulate. Defaults create banking system stress. More stress on a system already carrying $517 billion in unrealized losses. I've been tracking what happens when multiple stresses compound simultaneously, and here's what the data shows. During crisis periods, asset correlations converge to 1. What that means in plain English is that the diversification in your portfolio, the thing you were told would protect you, stops working exactly when you need it most. Let me show you the math on your standard 60-30-10 portfolio. 60% stocks, down 3%, 30% bonds. And here's what most people miss. Bonds are down 2% because of interest rate fears from oil-driven inflation. 10% international, down 4% because global conflict affects global markets. Run the weighted calculation. 60% times -3, plus 30% times -2, plus 10% times -4. That's negative 2.6% total. Your diversified portfolio lost 2.6%. You might have done better with just stocks. Diversification failed to protect you because everything correlated simultaneously. Because when the shock is systemic, when oil affects inflation, affects bonds, affects banks, affects stocks, affects international, there's nowhere to hide. Everything falls together. This is what Monday morning will reveal for millions of investors who believed they were protected. Part 4. The historical template. We've been here before, and here's what happened. Here's what I found when I pulled the historical parallel, and I need you to understand this because it's not analogous. It's nearly identical in mechanism. October 1973, the Yom Kippur War begins. Arab nations, in retaliation for US support of Israel, implement an oil embargo. Oil prices quadruple in months, not double, quadruple. Gasoline lines stretch for miles across American cities. Rationing is implemented. And here's the cascade that followed. Inflation spiked from 3.4% to 12.3% over 2 years. Recession followed. Unemployment peaked at 9%. The stock market declined over 30% from peak to trough. That recession lasted 16 months. Recovery took years, not weeks. Years. That crisis started with a geopolitical decision about Middle East conflict, a decision to support one side of a regional war. Arab nations retaliated by restricting oil flows through embargo. Supply shock created inflation. Inflation created recession. Recession created unemployment. Unemployment created social stress that echoed for a decade. Now look at February 28, 2026. The United States strikes Iran in support of Israeli operations. Iran retaliates with 200 missiles and explicitly threatens oil flows through the Strait of Hormuz. Supply fear spikes oil prices. Spiking oil creates inflation. Inflation will create recession if sustained. Recession will create unemployment. The pattern is not similar. The pattern is identical. What's different, and this is what I'm tracking most carefully, is the starting conditions. In 1973, US banking system was not carrying $517 billion in unrealized losses. In 1973, average credit card APR was not 23.79%. In 1973, household debt-to-income ratios were substantially lower. The resilience of the system today is lower than it was then. The shock is arriving into a more fragile structure. Now let me address the June 2025 counter-argument because you're going to hear it. Remember June 2025, the 12-day conflict? Oil spiked 7% but settled back within weeks. This will be the same. Here's why I think that's a dangerous assumption. June 2025 was 12 days. By Pentagon sources speaking to NPR, this campaign is expected to last several days at minimum. And several is a bureaucratic flaw, not a ceiling. Could be 10 days, could be 20. Could extend further if operational degradation of US forces in the region extends the campaign timeline. Iran's IRGC has explicitly promised relentless attacks. Relentless. That's not a figure of speech. That's an operational doctrine of sustained daily pressure. And here's the market structure reality I want you to understand. Markets can drop 3% in one day. Recovering to the previous level can take 3 weeks under normal conditions. If a new shock occurs during that recovery window, Iran attacks again, Hormuz partially disrupted, casualty figures emerge, that recovery resets, starts over from the new lower level. The pattern during sustained crisis isn't 2 steps forward, 1 step back. It reverses, 1 step forward, 2 steps back. Net direction is down. Down until the crisis fully resolves. How much down? Let me give you the scenario matrix I've built. If conflict ends Monday, you're probably looking at equilibrium 5% below Friday's close. If conflict continues 2 weeks, 10% below. A month of sustained operations, 15% below. If Hormuz closes even briefly, and I want to be clear, even a partial closure, even a threat credible enough to redirect shipping, we're looking at 20% below current levels in a rapid repricing event. Every scenario involves losses, only the magnitude varies. Part 5. The structural disadvantage. Why you're always last. I want to spend some time on something that's not being said plainly enough because it connects to everything I've shown you so far, and it's about timing. According to market microstructure theory, and this is well documented, this isn't my opinion, informed traders move first. They always move first. Uninformed traders react, and reaction is always slower than action. By the time retail investors, you, read about Friday's strikes in the news, opened their apps, decided to reposition, institutional investors had already sold, already repositioned, already captured gains on the move down. Retail selling after a 3% gap down means selling after the decline has already occurred. Selling at the bottom, locking in losses that informed investors avoided by moving Friday afternoon, Saturday morning in overseas futures markets. And here's the compounding cruelty. Your Monday morning sale doesn't just lock in your loss. It adds to the selling pressure that creates further decline. Your reaction to your loss creates additional losses for everyone still holding. You become a contributor to the cascade you're trying to escape. But here's the trap I'm watching, and this is the part that keeps me up, because there's no clean answer to this. If you sell Monday morning after the gap down, you lock in losses and miss the recovery if war ends quickly. If you hold, you absorb potentially deeper losses if conflict extends for weeks. There is no obviously correct choice. You're making a decision under uncertainty, with incomplete information, after the first major loss has already been locked in. Your choices are sell and lose, or hold and risk losing more. Neither is good. Both hurt. This is the trap created by being last to receive information in a market designed around information asymmetry. And that forced decision, that impossible choice, is itself a cost, a psychological cost. Because according to psychological research on financial stress, economic insecurity creates anxiety. Anxiety impairs decision-making. Impaired decisions lead to worse outcomes. Worse outcomes increase anxiety. This is a self-reinforcing loop that most financial analysis never accounts for. You check your retirement account Monday and see $3,900 gone. Anxiety activates. You spend the day distracted. Sleep suffers. Next day's performance suffers. Longer-term decisions suffer. The hidden cost of market volatility isn't just the dollars lost. It's the cognitive and emotional tax that follows you all week, all month, while you're trying to function normally in circumstances that are anything but normal. Part 6. The regressive impact. Who this hurts most and why it's designed that way. Here's the data I want you to look at carefully, because this is where the inequality of crisis becomes mathematically visible. According to Household Budget Analysis, a family earning $30,000 annually spends approximately 10% on transportation, roughly $3,000 per year. A 29% fuel price increase, which is what you get going from $3.50 to $4.50 gasoline, adds $870 to that transportation budget. On a $30,000 income, $870 represents 2.9% of total annual income. Nearly 3% of their entire year's earnings is gone, redirected to fuel costs they cannot reduce because their commute is fixed. Now look at the family earning $100,000. They spend approximately 7% on transportation, $7,000 annually. The same 29% fuel increase costs them $2,030. On $100,000 income, that's 2%. Significant, but proportionally less than the lower income family. And here's the critical difference. The $100,000 family has discretionary spending they can cut. They can reduce dining out, postpone a vacation, delay a vehicle upgrade. They have slack in their budget. They can absorb the shock by reshuffling priorities. The $30,000 family has already minimized discretionary spending. They're not dining out. There's no vacation to postpone. The vehicle isn't being upgraded, it's being maintained. Their budget is already at the bone. When fuel costs rise, the only option is debt. Charging necessities on credit cards at 24% APR because current income doesn't cover current expenses after the shock. And this is the debt spiral I'm watching activate in slow motion. Debt at 24% grows exponentially. Minimum payments increase. More income goes to interest. Less income covers necessities. Balance grows despite payments. More spending on interest. The spiral self-reinforces. It doesn't resolve when the shock resolves. The debt persists. The interest persists. The financial burden lasts years after oil prices normalize, after markets recover, after the war ends. Because here's what I want to be honest about. The financial system recovers. Markets recover, oil prices normalize, but your personal finances recover at a different pace, if they recover at all. If you were forced to liquidate retirement assets at Monday's depressed prices to cover an emergency, you don't participate in the recovery. The recovery benefits whoever held or bought at the bottom. You sold at the bottom because an emergency forced it. That loss is now permanent. Recovery that benefits others does not benefit you. Meanwhile, and this is the data point that matters for understanding who this system actually serves, defense contractor shareholders are seeing returns. Raytheon, Lockheed, Northrop Grumman. These stocks don't decline in military conflict, they appreciate. Energy company investors are seeing returns. Oil at $90 creates margin expansion for every barrel in the ground. Gold holders at $3,300 per ounce, up 22% in 2026 alone, are ahead while your 401k is behind. Money doesn't disappear in aggregate, it moves. From losers to winners, from those holding diversified retirement accounts to those holding defense stocks, energy positions, and physical gold. From those who didn't know to those who positioned months ago. The transfer is real, the transfer is measurable, and Monday morning is when the scoreboard updates. Part 7. The Compound Week. What Monday through Friday actually looks like, I want to walk you through the week ahead specifically, because understanding the sequence matters for whatever decisions you're making right now. Monday morning, you check the account. down $3,900 from the 3% gap down. That's the first number. Do you sell? Do you hold? You make that decision without knowing how long the conflict will last, without knowing if Iran will escalate further, without knowing if Hormuz will be threatened. You're making an information-incomplete decision under emotional stress. Most people choose based on fear or hope, not analysis. That's not a criticism. It's a structural reality of being a retail investor during a geopolitical shock. Monday afternoon, gasoline prices at the pump begin updating. You fill your tank at $3.90 instead of $3.50, 40 cents more, barely noticeable as a single transaction, $14 more this week, $728 more annually if oil stays here. Wednesday, prices rise again to $4.20 as oil hits $85 in spot markets. The weekly adjustment starts to feel real. Your fuel budget has moved from $70 to $84, potentially toward $90 by Friday. But wages have not moved. The employer has not announced a cost of living adjustment. There is no mechanism through which your income automatically adjusts to oil price shocks. Wages adjust on annual cycles. Oil adjusts on hourly cycles. The gap between your income and your costs is widening in real time. By next Friday, if Iran makes any credible move toward Hormuz, even a statement, not an action, markets will reprice again. Another down day, another gap, another layer of losses on top of Monday's opening. And you're in the same position. Sell and lock or hold and risk. What I'm watching is whether the institutional behavior confirms or denies continued stress. The specific signals I'm tracking are daily oil price movements relative to futures, US 10-year Treasury yields, which will rise if inflation expectations embed, CDS spreads on major US banks, which measure market-assigned default risk, and the Federal Reserve's standing repo facility usage, which indicates stress in overnight funding markets. If repo usage spikes and bank CDS spreads widen simultaneously, that's a banking stress signal on top of the market stress signal. That's a different conversation than a standard geopolitical market correction. Part 8. The equilibrium problem. What recovery actually means. Here's what I need you to understand about the word recovery, because it's being used carelessly in the financial press right now. Recovery to what? Recovery assumes a fixed destination, the pre-war price level. But if this conflict produces a new structural reality, oil trading at $85.90 permanently, inflation running at 5 to 6% instead of 3%, geopolitical risk premium embedded in energy prices indefinitely, then recovery to the old price level isn't the destination. The new equilibrium is lower, permanently lower. Here's how that equilibrium forms. War creates information. Information updates probability assessments. Updated assessments reprice assets. New prices reflect new probabilities, not temporary shock, but structural shift. If markets assess a 25% probability that Hormuz faces sustained disruption over the next 12 months, that probability is priced into oil permanently, not until the war ends. Permanently, until the probability assessment changes. The equilibrium I'm watching form is oil at $80.90 as base, not emergency. Inflation at 5 to 6% as structural, not transient. Economic growth revised downward as consumer purchasing power declines. Corporate earnings revised downward as input costs rise. Stock prices reflecting reduced earnings expectations. And all of this landing in your retirement account as a new, lower baseline from which the eventual recovery begins. How far below Friday's close is that equilibrium? I've given you the scenario matrix. 3% if it ends fast, 10% for 2 weeks, 15% for a month, 20% if Hormuz is affected. What I'm telling you is that even the best case, conflict ending Monday, involves a 5% permanent adjustment reflecting new geopolitical risk premiums. Your portfolio does not return to Friday's close under any rapid resolution scenario. The floor has moved. Part 9. The 3 asymmetric plays and what I'm watching. All right, I'm not going to leave you with just the bad news because that's not useful. Let me show you what I'm watching and what I'm tracking for asymmetric opportunity in this environment. First, energy. If you don't have energy exposure, whether ETFs, individual names, or commodities, you're sitting on the wrong side of the current trade. Oil at $90 means margin expansion across every barrel of production for US energy companies operating at 55-60 break-even. That's a significant profitability tailwind. I'm watching the XLE and individual names with domestic production leverage. The play isn't chasing oil futures. That's highly volatile and dangerous for most investors. The play is equity exposure to companies that benefit from higher oil prices with manageable balance sheets. Second, real assets with inflation protection. Gold is already at $3,300, up 22% this year. I know, that feels like you've missed the move, but here's what I'm tracking. Inflation expectations are not fully embedded in long-term pricing yet. If this conflict extends 2 to 4 weeks and oil stays above $80, we start seeing inflation expectations re-anchor higher. That's another leg for gold. Not because gold is a crisis asset, it's a purchasing power preservation asset. And purchasing power is being destroyed right now through the mechanisms I've walked you through: physical gold and silver in your possession or in fully allocated segregated storage. Not ETFs, not futures, not leveraged exposure, physical metal. I want to be specific about that because the counterparty risk on paper gold becomes relevant exactly when you need gold most. Third, defensive positioning in equities. Within your equity allocation, there's significant variance in how different sectors perform during sustained oil-driven inflation. Defense contractors appreciate, energy appreciates. Utilities, which have pricing power for inflation pass-through, hold relatively better. Consumer discretionary, highly leveraged growth names, and anything dependent on cheap financing deteriorates. The play isn't necessarily adding new positions. It's examining what you're currently holding and asking honestly, does this perform well in a 5 to 6% inflation environment with higher rates? If the answer is no, that's the exposure to evaluate. Fourth, and I'm adding this because it's the thing I'm watching most carefully, Treasury bills and short-duration instruments. If the Fed is forced to respond to oil-driven inflation with rate increases, or even just holds rates higher for longer, short-duration instruments become attractive relative to longer-duration bonds, the opposite of the 2021 hold bonds forever trade. The 2026 trade is short-duration, high-yield cash equivalents that benefit from the rate environment rather than getting destroyed by it. Part 10. The Forward Indicator Dashboard. What I'm watching in real time. Let me give you the specific signals I'm tracking so you can follow this yourself. These are the indicators that will confirm or deny the thesis over the coming week. Number 1, Brent crude spot price relative to the 90-day forward contract. If backwardation appears, meaning spot prices exceed future prices, that signals immediate supply stress, not just fear-driven speculation. Backwardation changes the trade significantly. Number 2, US 10-year Treasury yield. If we break above 5% on a sustained basis this week, that triggers a repricing in equities because the discount rate for future earnings rises. 5% is the threshold I'm watching. Number 3, SOFR spreads. The secured overnight financing rate measures stress in overnight funding markets. Spread widening signals banks are beginning to have difficulty accessing short-term funding. That's an early banking stress indicator. Watch SOFR spreads against Fed funds rate. Widening matters. Number 4, CDS spreads on major US banks. Credit default swap spreads measure market-assigned probability of institutional default. A 25 basis point widening is noise. A 50 basis point widening in one session is signal. A 100 basis point widening is crisis warning. Number 5, standing repo facility usage from the Federal Reserve. This is published with a 48-hour delay, which means by the time you see it, institutional traders already acted on it. But the trend matters. If usage is accelerating week over week, it means banks are accessing emergency overnight funding at elevated rates. That's the fragility I described in the FDIC data, becoming visible in live market action. Watch those 5 indicators. Together, they tell you whether this is a standard geopolitical market correction, painful but temporary, or whether it's a banking stress event layering on top of a geopolitical event. If it's the latter, the scenario matrix I showed you moves toward the higher-end outcomes. Closing. Tomorrow is already priced. What you do with the week ahead. All right, let me bring this home because I want to be direct with you about what I think the next 30 days look like and what I need you to do. 24 hours from now, Asian markets open. Oil price discovery happens in real time. Sunday night futures will give you the first signal of Monday's gap direction. If Gulf markets open Sunday and we see Saudi Arabia and Qatar down 3-4% on open, US futures will gap down 2-3%, and your Monday morning account will confirm what I've walked you through today. What I need you to do in the next 24 hours is not panic. Panic selling at Monday's open is the institutional trader's favorite outcome. Retail selling at the bottom provides liquidity for the smart money buying at discounted prices. Your panic is their opportunity. Don't give it to them. What I need you to do instead is assess your actual exposure against your actual timeline. If you're 5 years from retirement, a 10-15% drawdown is painful but not structural. If you're 3 months from retirement and fully in equities, that's a different conversation that needs to happen with an advisor who understands your specific situation. The timeline changes the decision completely. Second, I need you to assess your cash and credit buffer. The scenario I walked you through, oil-driven inflation adding $164 per month to household costs by April, is real. It's calculable. It's coming. If you don't have 3 months of expenses in liquid, accessible savings, the inflationary shock will force you to either take on high-interest debt or liquidate investments at a bad time. Either outcome is worse than the discipline of maintaining that cash buffer now. Third, I want you to ask yourself honestly, what's my oil and energy exposure? If the answer is 0, if you have no position that benefits from oil at 85-90, you're completely on the losing side of the current trade. You feel rising gasoline prices through your wallet while getting no compensating benefit through your portfolio. That asymmetry is addressable. Here's the honest conclusion I keep coming back to. The $3,900 Monday morning loss, the $2,000 annual inflation cost increase, the debt spiral for families operating without a buffer, none of this was inevitable. Informed investors positioned months ago. Gold at $3,300. Energy stocks already pricing in elevated oil. Defense names already elevated. The positioning happened before you could act because information flows unevenly. That's the structural reality I've been walking you through all day. But the next positioning opportunity, the next asymmetric trade that reflects the new post-strike reality, that window is open right now, before the full market repricing, before the banking stress becomes headline news, before the FDIC data from Q1 2026 gets published showing what 9 months of elevated losses plus an oil shock did to bank capital ratios. That data will be published with a delay. But the reality it reflects is being created right now, tonight, as Asian markets prepare to open. This is what I need you to understand. Monday morning is not the end of this story. Monday is the first chapter. The mechanisms I've shown you, oil to inflation, inflation to bonds, bonds to banks, banks to credit, credit to economy, economy to earnings, earnings to stocks. Those don't resolve in a day. They resolve over weeks and months. And the investors who understand the full transmission chain, who are watching the 5 indicators I gave you, those investors will see the turns coming before they're obvious, before they're on CNBC, before they're priced in. That's what this analysis is for, not to tell you that you're helpless, not to generate panic, but to give you the framework to see what's happening before the crowd does, to make decisions based on mechanics, not emotion, to position for the scenario that matches the actual data rather than the narrative that's most comforting. The war started Saturday, the market costs started Friday, the wealth transfer starts Monday. The question I want to hear from you is, where are you positioned and what are you watching? Drop it in the comments. I want to know where the community stands on this. Do you think the Fed steps in if banking stress accelerates? Do you think Hormuz gets threatened, or does Iran keep its attacks asymmetric? Your read matters, because in this environment, the collective intelligence of people actually tracking this data in real time is more valuable than any single analyst's projection. I'm watching. I'll update as the numbers come in overnight. Lock in the 5 indicators. Check Sunday futures at 6 p.m. Eastern. And stay ahead of the crowd. This is Andrew John. Asian markets open in 24 hours.